So this noise that we saw on Friday, this pullback that everyone freaked the hell out about after the price of gold and silver had been going up nonstop, the market needs to exhale too. The big traders do take profits. But look, here we are right now, pretty damn close to where we were when the market got whacked on Friday, with gold up $60 right now to 43.12 and silver up to 52, almost 52 and a quarter. So yeah, it's buying the dip is the way to get ahead. But even more appropriately, if you don't understand, none of us do really, where things are going, I see a primary trend going much higher for a myriad of reasons that I can talk to you about. But if you're not sure, then cost average. Let purchasing over time smooth out the uncertainty. And that is the only way to do so, because really none of us know what the hell's going to happen tomorrow. I think you just have to sometimes trust your gut. And if you're uncertain and feel a little queasy about making a large purchase at a certain time, even after it falls, which is buying, catching the falling knife is hard, cost average your position, and over time that will smooth out the uncertainty. Gold being reintegrated into the monetary system now for a while, and this whole gold linear progression of events I saw things starting to change in 2019 with the formation of BRICS. And I've talked on your show and with Jay forever about BRICS, so we're going to put that on the side burner for a moment right now, because what is very unusual, at least very different than what I've seen in all of the years that I've been trying to analyze this situation, most of it focused on the global south and the accumulation of metal by the BRICS nations, not just metal, all commodities, and the expansion of the Belt Road Initiative and all of the partners that are involved in that system are all very resource rich, many underdeveloped, but resource rich. And you could sense that we are moving into a world where resources matter. It's kind of like that video game on your phone where you start with like a hammer and way back when you start with like a hammer and a match, and then you build your empire through the acquisition of commodities. Well, that's changing, but that hadn't hit the United States until what I believe was November, when Trump won the election. And things have begun to massively change in regards to the way the most sophisticated traders on Wall Street look at precious metals. It's one thing for the central banks to buy it, which to me is as bullish as it gets, right? When you see the central banks loading up on gold, and even more so, Daryl, taking possession, pulling the metal off of the LBMA, pulling the metal off the COMEX, taking it back from the New York Fed, removing counterparty risk.
When central banks load up on gold, it's bullish. But it becomes transformative when major commercial banks in the U.S. decide to take delivery, remove counterparty risk, and hold actual physical metal rather than paper claims. Suddenly the narrative shifts. Gold and silver become assets that no one else's liability, a rare category in today's leveraged world. When firms such as Goldman Sachs or Bank of America revise forecasts and speak of substantially higher gold levels, it's not just market talk. It's a signal to large institutional portfolios that the safe haven status of these metals is being repriced.
And gold and silver are two of the only assets in the world that are assets that are simultaneously no one else's liability. That's big. But when you see the most sophisticated, well-informed, and wealthy traders on the planet, that being the big commercial banks in the U.S., stand for delivery and take possession and change their tune, something is different, very different. Let me give you an example. I'll give you 4 or 5 examples. We'll start with Goldman Sachs. Goldman Sachs came out and said, in fact, they just revised, I just wrote this down here today, they just revised their numbers, which isn't part of what I wanted to tell you, but they just revised, Goldman Sachs did, their numbers. Give me 1 second here. I will find it. Yep. On Monday, Bank of America raised its forecast for silver to 65 by the end of next year, and gold to 5,000 by this year. But we're going to talk about Bank of America too. Goldman Sachs, they came out and said if the market even senses for a moment that the Federal Reserve has lost its independence, you'll see gold at 5,000 like that. Well, you look at Stephen Mirren. Stephen Mirren is the architect of the Mar-a-Lago Accord. Stephen Mirren was Trump's advisor, still is, and he filled the vacated spot at the Fed. What independence? There is no independence. You look at Bo Hines, I think is his last name. He was Trump's crypto czar. He is now running USA Tether. The whole system is lacking independence. So Goldman Sachs is more or less telling you $5,000 announced gold. I mentioned Bank of America. You look at their high buck analysts, a guy that sends out letter, and these people I'm mentioning, they're talking not to the plebes, they're talking to the institutional traders, because Michael Hartnett's letter, I don't know how many tens of thousands of dollars it is a year, but he's a smart dude, a very smart dude, and he just came out and he said, well, let's go back 1 second, because before that you had Morgan Stanley, and their chief investment advisor, CIO, says, no more 60-40, 60 stock, 40 bond. Let's go 60-20-20. Sell 20% of your bonds and buy gold. So they're saying 60% stock, 20% gold, 20% bonds. Never happened before, right? Most financial advisors would say, fine, 5%. You know, they acquiesce. Now they're saying 20% and cut half your bond holdings. Back to Michael Hartnett.
From 5% gold in the portfolio to 25% gold is a seismic shift in asset allocation. Major banks and high-end analysts are recommending portfolios where gold is not an afterthought, but a central component. For instance, some are suggesting 25% stocks, 25% bonds, 25% short-term treasuries, and 25% gold. These changes reflect deep concern about the bond market, fiat currency debasement, and the validity of traditional 60-40 stock-bond mixes. This reallocation suggests insiders believe we're in a regime shift, not just a cyclical bump.
The big buck analyst who speaks to the high institutional level traders and clients, no, not 60-20-20. He says 25-25-25-25. 25 stock, 25 bond, 25 short-term treasury paper, 25% gold. Really interesting. Never heard that before. How about Jeffries? Now, Jeffries means a lot to me. About 20 years ago, Prudential Beige nominated Miles Franklin to be an authorized reseller for the U.S. Mint. At the time, there were only 27. They don't really talk about it too much anymore. It's even hard to find. You got to call the Mint and ask them. But we're one of 27 to my last count. I don't know how many more have been nominated. They can do one per year, the primary distributors. 1 in 27 authorized resellers. So that was Prudential Beige. But Jeffries bought Beige. And for several years, Jeffries was a primary distributor for all of the world's mints. They understand gold very well. They subsequently closed their gold division. They're not a primary distributor anymore, but their head trader just came out and said their next stop is 6,600 on gold. But maybe the biggest one of them all is Jeffrey Gundlach, the bond king, the man who made his mark on selling bonds, right? The antithesis of gold, a safe haven asset, but pays a yield, right? He says 25% of your assets in gold is not undervalued or is not overvalued, excuse me. So you have the most sophisticated traders on Wall Street. You have the most high paid buck analysts, including chief investment officers, all whistling a very different tune as it pertains to how much gold should be in people's inventories and in their holdings. And the people they are speaking to are the big money, big buck people who position well before the crowd does. So this noise that we saw on Friday, this pullback that everyone freaked the hell out about after the price of gold and silver had been going up nonstop, the market needs to exhale too. The big traders do take profits. But look, here we are right now, pretty damn close to where we were when the market got whacked on Friday, with gold up $60 right now to 43.12 and silver up to 52, almost 52 and a quarter. So yeah, it's buying the dip is the way to get ahead. But even more appropriately, if you don't understand, none of us do really, where things are going, I see a primary trend going much higher for a myriad of reasons that I can talk to you about. But if you're not sure, then cost average. Let purchasing over time smooth out the uncertainty. And that is the only way to do so, because really none of us know what the hell's going to happen tomorrow. I think you just have to sometimes trust your gut. And if you're uncertain and feel a little queasy about making a large purchase at a certain time, even after it falls, which is catching the falling knife is hard, cost average your position, and over time that will smooth out the uncertainty.
Enter the Robert Triffin dilemma, the notion that a country issuing a global reserve currency runs into contradictions, domestic versus international policy goals. In the U.S. case, some policymakers openly question whether the dollar's strength is now a liability for manufacturing and long-term growth. Coupled with rising national debt, shifting production away from the U.S., and heavy import dependence, the situation is ripe for a currency revaluation or re-anchoring of value, where gold begins to play a renewed monetary role.
I don't remember what the topic of our last conversation was, you and I, but I bet it's what I'm going to tell you, because what I have been talking about, and one of the few who's out there either stupid enough or maybe I'm on to something, I don't know. I felt the same way with BRICS in 2019 when I was the only one saying it, and 2020 when I was the only one saying it at Jay's conference, and everyone thought I was nuts. And then all of a sudden, here it is. I see something very clearly, and either I'm stupid to say it or maybe I'm just courageous enough to say it. And I've been saying that that's exactly what they're going to do, but I have a kind of a roadmap on how they're going to do it. I've been saying that's exactly what they're going to do now for the better part of 6 months in almost every interview that I've given. And I couldn't agree with that assessment more. Let's kind of break it down a little bit. So, okay, it is a debasement trade. Let's start with Vice President Vance. Vice President Vance came out and cited Triffin's dilemma on White House letterhead, I don't know how many months ago, and where he said, look, Triffin's dilemma, by the way, for any of your listeners who aren't polished up on it, it's fairly simple to understand. It says that if you are the world reserve currency, it's an economic theory that I don't know how far back it goes, but if you are the world reserve currency, you will always run a trade imbalance. And the easiest way to explain it would be that the world, who needs dollars to buy everything from oil to just about any other commodity and to use as collateral for trades and whatnot and loans, they need dollars. And we cannot provide the world enough dollars just simply through trading with them alone. So they continually need to sell their currency in the open market, which pushes it down to buy our currency, which in theory would raise it up. And so over time, what happens is their currencies depreciate against ours, making manufacturing in those countries so much more affordable, makes the goods that we buy, a massive subsidy to the consumer, way cheaper. The world reserve currency has given us very, very low price goods at Walmart and Target and whatnot, but it's hollowed out our manufacturing.
Some analysts argue that this is not random accumulation. It is strategic. A Treasury Secretary who publicly identifies as a gold advocate, potential reconnection of gold to Treasury securities, and orchestration of longer-term debt instruments backed by metal, these are signals. A plan unfolds. Import physical gold, build inventory, then step change the valuation of gold on the government balance sheet. If gold is marked up massively, it unleashes fiscal capacity, allows for a weaker dollar, and reshapes the monetary system from the back end of the bond market.
And so he says, look, Vice President Vance does, on White House letterhead, look, this is no longer a good deal for the United States. It is a boon for the consumer. It is a massive drag and hindrance on the producer. And in essence, we've lost all of our manufacturing. Okay. So that's the beginning of it. You look at Stephen Miran, the architect of the Mar-a-Lago Accord, who is now at the Federal Reserve, who was Trump's advisor. His whole thesis is to devalue the dollar, in essence, to reshore manufacturing. Well, how do you reshore manufacturing? My theory, and I've been saying this publicly, debasement or what, is that they are going to default on the World Reserve Standard. They're not going to default on the system, but they do not want to be the world reserve currency anymore. Even President Trump said, yeah, a strong dollar is great, but it's bad for manufacturing. No one wants to buy our stuff or come and do tourism here if the dollar is really strong. And so they're giving you little crumbs, little hints. So we look at all of the gold that's come into this country since November, billions and billions and billions and billions and billions and billions and billions every single week and month into COMEX. And no one can tell you who the hell's buying it. Who's got that kind of bread? A lot of it is stuck in the COMEX. They're leaving it in the COMEX system because at this point, that money still trusts it. And a lot of it's leaving the COMEX. Where's it going? Who's buying it? Is it the Western banks covering their short positions? Maybe. Is that gold then going to the Treasury Department under the guise of the Exchange Stabilization Fund that the Secretary of the Treasury runs, who just happens to be a self-proclaimed gold bug, who said he wants to preside over a new monetary system, a new Bretton Woods, who said that he wants to remonetize the asset side of the U.S. government balance sheet. Well, what the hell does the U.S. government balance sheet consist of? The largest asset is student debt. The second largest asset is military. They ain't getting remonetized. You could remonetize asset number 3, I guess, which is national parks and land, but why not revalue gold, which is at 42.22 on the balance sheet? Of course, it hasn't been audited since 53, but this is a gold bug who understands gold, who speaks of a new monetary system. And I would argue with the passage of the Genius Act, there is a new monetary system. So I'm still with you here. So how does this all happen? All right, so we import all of this gold. 6 months ago, I gave an interview with Judy Shelton. And Judy just gave an interview with Michelle McCory, who also runs my YouTube channel. And she said the same thing on my show and on Michelle's. And in essence, she just did an interview with Adam Taggart, said the same thing. Now she was the primary or Trump's nominee to run the Fed in 2016. And although it wasn't confirmed, she said to me in no uncertain terms on my YouTube channel, Andy, July 4th, 2026 is a very, very big day for President Trump. It is the 250th anniversary of the United States, and he is going to reconnect gold to the Treasury market, to the back end of the bond market.
We cannot know exactly how the film ends, but the trend is clear. Gold and silver appear to be underpriced relative to their policy role and institutional demand. If you are uncertain, dollar cost average into positions rather than try to time the exact bottom. Hold physical where possible. Understand the role of delivery and ownership. Monitor policy pronouncements related to manufacturing, currency reform, Treasury balance sheets, and reserve holdings, because we may be witnessing a deeper pivot in the monetary order, one where precious metals reclaim a position not just as hedges, but as character-defining assets.
The long end. And in her book, As Good as Gold, she says 50-year treasuries will be the long one with a tiny, tiny bit of interest. 0.5%, 1%, something like that. Redeemable in gold. She goes on to say 5, 10, 20, 30, and 50-year treasuries in her book. All right, so follow me here. You have a Secretary of Treasury who wants to preside over a new system. You have Stephen Mirren, who's at the Fed now as the advisor. The Mar-a-Lago Accord, devalue the dollar, bring back manufacturing. You have Trump talking about bringing back manufacturing, starting with tariffs. We've got to bring back manufacturing. And you know what, Daryl? If we don't, our kids are dead. And their kids are even more dead. We don't make anything anymore. AI is going to kneecap jobs. 60% of America has no college education. No one's got savings. We need to bring back manufacturing, period. Okay, how do you do it? The strong dollar and Triffin's dilemma says you can't do it. No one will buy our stuff. The dollar's too strong. The cost of employment, everything, labor. We don't have any manufacturing anymore. We've sent it all offshore. How are you going to reshore everything? All right, I got you. So if Judy is right, first and foremost, and they do peg gold to the back end of the Treasury market, first, you have to let it go much higher. Now, what has gold been doing? Stair-stepping, 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 outpacing everything, and no one notices it. And people look at Bitcoin and they look at NVIDIA. They don't notice gold, that it's outpaced everything. They don't notice that it was up 40% last year, over 50% this year. That's not sexy enough unless it's triple-digit gains or something like that, but they don't notice it. Now, I believe that they are going to let it go much, 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 much higher and then revalue it. Revalue it, even if they just market to market at that point. Right now, it's valued at $42.22 an ounce. James Rickards is publicly saying $24,000 an ounce. Mike Maloney, $10,000 an ounce. It's as simple as them revaluing gold, telling the president tells the Treasury Secretary to revalue gold, who tells the Federal Reserve. They're issued gold certificates. The Treasury issues the Fed gold certificates, who then every $4,000 increase in the price of gold, the Treasury general account will get $1 trillion free and clear. So if they moved it to 24,000, hypothetically, not only would it benefit every central bank on the planet who's been buying it, but in essence, it would allow the Federal Reserve to receive those gold certificates, for which, in theory, at least it says so in all the documentation, that they hold the gold, but it's not theirs. They're entitled to the fiat value of the gold. The gold belongs to the American people. They push a button, create $6 trillion, and give it to the Treasury, which devalues the dollar massively. devalues the dollar massively. The higher the price of gold goes, it's not even the gold price, it's the devaluation of the dollar. That's what they want, the debasement. They're debasing the value of the dollar by letting gold and Bitcoin go higher and higher and higher and higher.